Hey folks, welcome to Tools & Co. This is going to be a quick session on what I call income statement gymnastics. So in Tools & Co, this is the data in column B that was provided to us. The important thing about Tools & Co is that it's not a single product, it's a company selling multi-product. Therefore, we are given a gross profit percentage of 22.6%, where our cost of sales is 77.4%. And instead of using rands, we are now going to use percentage. So in question 1, they're asking us, what if our revenue grows by 20%, and there you can see 20% growth. I multiplied 1.5 million by 1.2. Then I asked myself, well, what is 77.4% of the sales? That will tell me what my variable costs are. And what are 22.6% of sales? That will tell me my gross profit. Less the fixed expenses gives us the net profit at the end. So remember what happens when our sales increases, so do our variable expenses. These do not remain the same. And the question says that the proportion remains the same, and that's referring to the variable expense percentage. In question 2, they said to us, what if this manager earning 80,000 is replaced by a new manager earning 60,000? Well, the top half of the income statement remains unchanged. The only thing that changes is that 80 becomes 60, therefore our expenses have reduced by 20,000, and therefore our profit has increased by 20,000. In question 3, they ask us, what can sales decline to before operations result in a net loss? The point before we make a net loss is the point of break even. So we're going to set this up as a break even question. And the rules of break even, we must have the grid. We must put in the given information, and in this case these margins apply. At break even the profit is 0. At break even the GP is equal to the fixed expenses. Rule number 5, take the GP, divide it by the margin, and you will get the sales required to break even. So that is what sales can decline to, 1.3 million and some change, before they make a loss. In the last question, let me open that up. In the second last question, question 4, they say to us, well, what if we want to make a profit of 100,000? This works in the same way that the break-even question works, except that we're not forcing the profit to be 0, we're forcing the profit to be 100,000. And as you work up the income statement, take the 100,000, add it to your expenses to get your GP. Take your GP, divide it by the margin in order to get sales. Now, if I compare question 1 and question 4, you can almost see what's going on here. So notice all the way down here at the bottom. Here we made a profit of just under 100,000. This has gone up to 100,000. If we're going to make more profit and the margin is going to stay the same, we would expect that there would be more sales, and that's the case. A little bit more sales got us a little bit more profit. In question 5, the final question, they tell us it's a break-even question and that the margin has come down to 20%. So we're going to make this 0. We're going to make these two equal. GP divided by margin gets us our break-even sales of 1,545,000. And there is some quick and dirty income statement gymnastics using Tools & Co.